Well, I'm excited to introduce Bennett McDowell and a shout out to my gal pal, his wife Jean. I miss our cocktails in California. Soon I hope. Bennett McDowell with Traders Coach founded them to develop a niche in active trading and investing for a community of high net worth clients using his own proprietary system, which later became to know as Applied Reality Trading, or ART system for short. It is now used in over 80 countries around the world by sophisticated hedge fund managers and individual investors. So extremely pleased to have Bennett here today. He's going to share the magic bullet for trading election volatility, why it happens and how to profit from it, pro strategy for sizing up high probability entries, and creating stop loss exits that breathe with the market. So Bennett, welcome.
Are you all right? Let's see if this is working. How you girls doing?
Good. Everyone is doing screen share, not getting on camera. If we didn't
I have to put makeup on.
That's because I still have my pajamas on, you know.
We normally do too, right?
Raleigh, how are you?
I'm doing great, Bennett. We're delighted to have you here.
It's great to be here. All right, let me share my screen. Let me see if I can get that squared away. Okay, got to make sure I got the right one here.
Don't show us the wrong.
That'll do it. Hopefully you can see it.
That we seeing stop signs or direct.
Yeah, that's it. So
okay.
that's the start. And basically we're calling this presidential elections and markets. And I think that pretty much sums it up, don't you?
I think
Questions? Anybody have questions?
Yeah, I think we're done.
Yeah. All right.
Okay, so we'll get started. But anyway, elections and markets, cause a lot of volatility and confusion. So we're going to focus on that today. And it's just great to be here. And Pat and Nikki and Raleigh, really great to touch base with you all again. And thank you for having me. So let's start out with that. All right. So they've already introduced me, but I do want to welcome everybody to our website at traderscoach.com and give you a little history. I've been in the markets now for almost 30 years, and we started traderscoach.com back in 1998. Started doing well, so we incorporated in 2000. And then we started bringing to the market software, online courses, and the rest is history. So we've been doing this for quite a long time, and we focus on risk control. We focus on entries and exits, of course, and we delve into that. But psychology is also an important part of it. So we deal a lot with psychology as well. We also run day trading rooms. So if you're interested in trading the futures, we trade the S&P, the NASDAQ. We trade gold. We also trade oil. Those are the four primary markets we trade. And so we do that in our day trading room. And then we have something called Yummy Trades, which is a 24/7 trading room. It's not a day trading room, but it is a trading room. So if you're interested in any of that kind of stuff, drop by our website, check it out, and you can see if that's something you'd be interested in. I also have 4 books available, and probably the best place to go is Amazon. We talk a lot about money management out there, and we talk a lot about our trading system called The Art of Trading. Survival Guide for Traders is basically, that's a nice book if you're just getting into the markets. There's a lot of reference material in that book, but the goal of that book was really to bring you up to a level where you could trade from home, kind of like a professional hedge fund. So that was really kind of a cool thing that we did with that book. And then we focused a lot on the Elliott Wave as well. So that's our most recent book. I'm actually working on another one as well. All right, before I go any further, I got to figure out how to bring up the messages. So Raleigh, help me with that. I see the Q&A, but is there a message area?
Okay, so I think, Bennett, if you go under where it says more, you'll see 3 dots where it says more.
I'm there.
And if you click
Chat.
on that, you should see chat.
Okay, there it is. But I don't see it. I clicked on it, but I don't see it.
That's because Jean is taking it from you.
I'll tell you, what am I going to do with her?
But
All
what
right.
we can do is this. We're going to be monitoring the chat and the Q&A panel. So if there's any point in time when you stop or you want to see
That's
if there's
fine.
questions, we could feed them to you too.
Okay, that works. All right, because I just got a lot of questions I'm going to ask folks. So just kind of see what they say and let me know. One of the questions I wanted to ask for everybody is, what does the word election symbolize to you as a trader? So when you think about trading the financial markets and you have an election year and you get closer and closer to the election, what kind of, if you could think without thinking too much, what one word comes up in your mind?
Let me see. Confusion,
Okay.
uncertainty, trust,
Interesting.
volatility,
Okay.
sit on your hands.
Okay.
Those are pretty much the ones that are
Yeah.
coming up like that.
And that's what I would expect. All right. Basically, volatility, confusion are some of the big ones. That I think-
Opportunity is coming
An
in pretty strong.
opportunity. Absolutely. Yeah. Okay. And I think when we think about the elections, and this is not necessarily a question, but more of something we can talk about, the elections do affect the markets because they create a lot of uncertainty in the markets. And markets don't like that. They don't like the uncertainty that can be created not only by elections, but other events at times as well. So that uncertainty creates volatility and it also creates chaos in the market. Now, the thing for traders is, how do you capitalize on that? And how do you deal with that? Because volatility, like one of the viewers said already, can create opportunity. And so we want to be able to take advantage of the opportunity. But also, too, there's another thing that volatility creates, which we're going to discuss as well. And that is sometimes you can be right on the direction, but because of the volatility, you get stopped out more easily than in a normal behaving market. So you have to learn how to deal with that type of difference during a time like this. And so my next question is, how many of you have really experienced getting stopped out of trades based on volatility this year, especially as we got closer and closer to the election? Volatility has been really, really tough because you can be right on the direction of the trade. In other words, if you're long and you got a target zone, you can be right on that. But what happens is that the volatility takes you out of the market because you didn't have your stop placed correctly and to allow for that volatility. So how many people, and Raleigh, help me out with this, just let me know what they say. I'd be interested to see how many people are being affected by that. Because I would imagine a lot of people.
I think everyone's being shy, Bennett, because they're
Okay.
not.
All right. Don't be shy. This is a workshop. Don't be shy.
One person said, well, of course, who isn't? But
Okay, that's all right.
yeah.
All right. So my goal today of this presentation is to not only increase your awareness of how volatility gets generated, but we want to give you one unique method of how to handle volatility in today's markets, where one day the market soar, the next day it falls off. And also, too, we experience this on intraday timeframes as well. But a lot of people are experiencing this on position trades where they'll be going in for a few days or a few weeks only to find one market's up 500 points one day and the next day it's down 500 or 600 points. And it's very difficult to gauge where to properly place your stop, even once you're in the trade. So that's kind of a tough thing I think people have been dealing with. And there's many ways to deal with that. And we'll talk about that as well as we get a little bit further into the presentation. All right, so we kind of, I'd be interested to know out there if people have a plan, and I don't know if anybody will answer because we got a shy group, but if anybody has a plan to deal with volatility, or if they're just going along at the same pace that they have always been, but also suffering more stop outs.
Yeah, I mean, let's see here. Day trade, options straddle, position size smaller, don't use stop, sell options. Times with high volatility, just sell options. You know, that's the kind of
Exactly. And that is a very good point, because options are a great way to deal with volatility. Even if you don't sell them, if you're a chart person and you have a particular target zone you're shooting for, and you just simply want to buy a call option, a little maybe in the money, but there's option software for that you can use to pick the best option. That's not a bad way to go, because then you don't have to worry about stops at all, because your risk needs to be built into the option itself. And a very simple way of doing that is take 2% of whatever your account size is and don't buy any more than 2% of an option when you play it. That way, if it expires worthless, it would be the same as if you got stopped out on a normal trade. So that's one way to do it. There's more fancier ways to doing that using spreads and so forth, verticals and things like that. But options certainly are a great way to deal with volatility. All right, some more examples of volatility might not be just associated with the election. For example, the terrorist attack back on 9/11, 2001 created extreme volatility during that time and for some time thereafter. Any war, okay, can have that. I mean, wars have been around forever. Here's 1941, Pearl Harbor. All right, global medical crisis, COVID. All right, elections, Brexit, okay. All these things create volatility and just plain old market crashes out of nowhere, okay. So we've had the depression and the recessions of 2008 that created a lot of volatility too. So you have to be on guard for volatility as a trader, and you have to be able to assess when it's severe and when it's going to affect your normal style of trading. And one of the ways that we look at that is by looking at price bars on a given chart that we actually trade. So we'll talk about that in a minute. All right, but typically, like we discussed, financial markets don't like uncertainty and they respond with extreme volatility. Once certainty is restored, the markets will return to business as usual. Volatility is a measure of price change during a specific amount of time. When markets are volatile, this means that prices are changing fast in a short period of time. On the other hand, non-volatile markets refer to markets where price changes very slowly, in an orderly, unchaotic fashion or remain totally unchanged. And I think pretty much everybody knows that. But we might have some new people here, so it's kind of good to cover that. All right, now, when we look at charts, okay, extreme volatility can be seen by price gaps, either up or down, elongated price bars, sudden volume surge, extreme price movement, excessive momentum. And momentum is how fast price moves in a given period of time, either up or down. All right, so if you trade long enough, sooner or later, you will experience these sudden, unexpected periods of volatility in the market. And this is usually when traders get whipsawed. And whipsawed is a very annoying thing. And you have to realize when you're being whipsawed, and what are some of the ways that you know you're being whipsawed versus just getting stopped out normally? So that's a question. How do people know when they're whipsawed? I'd like to hear some answers. And Raleigh, again, if you could help me out with that. I'd like to hear what they have to say about that.
Okay, so, how do we know long tails on your candles with spikes? Multiple bars moving together in the same direction, trading in a tight range.
How about just a bunch of losses in a row?
Okay, thumbs up, thumbs up.
So usually, if you tested your system and you know how it works normally, if you start getting out of those stats, in other words, if you start, let's say your system says, okay, I can have up to 3 or 4 stop outs in a row, and that's operating within the normal limits of my trading system. So if you start getting more than that, then something's going on. And you have to examine what it is. And if it's a problem with being stopped out, but you're right on the direction, in other words, your trade would have been okay, but your stopped you out before the trade was allowed to be profitable, then you have to consider being whipsawed as one of the biggest problems that you're having. And that can even happen on markets. Most people think when you get whipsawed, it's really just a matter of being in a channel and the market's going up and down, up and down, up and down. But you can actually get whipsawed in other ways, even in a trend. So you have to really take a look at each particular situation in its own merits. So whipsawing is something I think that's best looked at if you're starting to operate starting really to operate not within your normal standards of your trading system. All right. So think about that. I think that's an important thing to think about. Now, one of the things we're going to talk about here is using volatility to create an exit strategy. And I'm going to show you really quickly how to manually calculate a very simplified stop loss situation using a formula. And it can be used for initial and trailing stop loss exits. This method's quick. You can use it intraday, and we do. And also you can use it on position trades or even longer term trades if you want to as well. And it really is very simple to use. I'm going to show you a chart in a minute, but basically you want to visually look at the price bars and take a look at the price bars that are forming compared to the price bars that have previously formed. And this basically could be done visually, or you can do this quantitatively by measuring the highs and lows of the price bars. And we're going to show you exactly, we have a whole formula here where you subtract the lowest price from the highest price within the last 10 price bars. But I think it's good to take a look at a chart for this. And let's just see, this is the overall market. And one of the things you want to take note here, and let me just grab a pointer, is that you got to this area here and you started to experience excessive price bars. So when you see this type of thing originating and you're not in the market yet, these are areas that actually become places where you can enter the market. And if you enter the market, you can also use these places for stop loss setting as well. So in this formula, basically, if you were considering a bearish trade, let's say you went short on this or for whatever reason, you may have your own trading system, you're short, and you experience something like this situation on a chart. What we like you to do is count the previous 10 price bars. All right. Find the highest price bar in the previous 10 and the lowest. And so if it's the highest price bar in the previous 10 and you want to take a short trade, let's say prices go below here and you want to take a short trade, then you want to set your stop at a certain level, as we're going to tell you based on the calculations. So let's just walk over and do a close-up of this slide on the next slide so you can actually see this. So you actually, if you showed up at this market, you could actually consider a long or short trade, depending on which way it breaks out. So if it breaks above the elongated price bar at the top, you could go long. If it breaks below, you could go short. Then the next question is, do you put your stop? And so in a situation like this, if you were going, we'll take the long trade first, and then we'll back it out and take the short trade. So if it got above 91.90, all right, then the next question, or above the high of this, the next question is, where do you put your stop? And you're going to want to put it a certain distance below one of the lowest price bars in the last 10 price bars based on this formula. And so what we do is we take the high price in the last 10 bars, which is 91.90. Then we take the low price in the last 10 bars, which is 72.50. The difference is 1940 divided by 10 is $1.94. So then we subtract the 194 from the lowest price bar to get 72.50 as our stop loss for that particular trade if it was a long trade. Likewise, you would reverse the process. If you were going short, you would add the 194 to the top, and that would be your stop loss for a short trade. Now, that is a very simple thing that you can do on any time frame in any market. And some people may be doing this type of thing now, depending on their style of trading. But this has been a great way, even when you're in a trade, to trail your stops. So if you're trailing your stops and the market becomes volatility, let's say you go in and it's not volatile, and then the market becomes volatile, then this is an excellent thing you can implement right away during the trade to manage the trade for you. And it's very simple. So it can be done on any time frame, any market, and we use it a lot. So it's very simple. And this is one that I wanted to share with you because I think everybody can implement this right away. Now, the next thing is, well, this is the solution to that particular chart. But also, too, let me just go here and talk a little bit about some of the ramifications of taking this type of strategy into account. So when you detect high volatility during a trade, we want you to think about placing your stops in a different fashion than what you may be used to. And in doing so, what we have found during the markets that are created around elections and things like that we're even in now, that this type of formula works really, really well. So I'd like to have any feedback, Raleigh. Anybody have any questions on the actual formula or anything about that?
And Bennett, just so that I understand this, obviously this is these are moving targets because you're looking backward for the previous 10 bars.
That's correct.
So as the market moves forward, et cetera there. Okay.
Yeah, exactly, Raleigh. And that's how you would trail, you would use this system as the market, let's say the market moved up from here. And then you keep your stop here, but then you would go ahead and move your stop up if the market returns to a normal volatility based on the previous 10 price bars.
Okay.
Okay. And then if the most recent price bars, if it starts getting volatile again, then you would implement this again.
Okay. All right.
Okay. So this is just one of several ways you can do it. Options is a great way to handle it as well. Okay. No question about it. A lot of the trades that we've been taking, we have an indicator that gives us a target range called the PTF indicator, which is about 75% accurate. Not 100, but 75%, which is pretty good in the markets. Anything above 60 is pretty darn good. So what we do on that when there's periods of volatility is use this type of situation where we calculate where to put our stop, but we also may just simply do an option play on it as well. So there's many ways to skin the cat. But this is just one I wanted to share with everybody today. All right. So that is pretty much it. If you're interested in further study on this, we do have an online home study course where we go over high volatility exit plans. We have a lot more, many, many more in there. So that is just one of the many that you could use. And I guess I'm not sure if this link is correct. Gene says there's another link that you guys have if they're interested in this. But this is a combination of video instruction as well as examples and formulas and all that kind of good stuff that you can apply in both bull and bear markets.
Yeah, what we've done, Bennett, this will work. We also created sort of like a special version of that. Both of them takes people to the same place.
Okay, well, if you'd rather use your version, then please tell everybody to use that.
We're good. We're good either way here.
Okay, cool. All right, so any questions before that's pretty much all I got for today. So any other questions before we move on?
So from that standpoint, we've got, obviously folks, out there, as I understand it, Bennett, we're talking about dealing in volatile markets. And what you want to do, as you said, is you want to avoid the whipsaw. And as somebody wrote in here, he says, you know what whipsaw is for me? I go long, the market goes short. I go short, the market goes long. That is the classic. If it happens a lot,
then yeah, that's whipsaw.
Yeah, and then I think that the point that you raised on that as well, in particularly, I'm a futures trader. So in trading with futures, one of the biggest challenges has been you gauge the direction that the market is going in, but it tends, it will double back on you and may take your stops out and then keep on going in the direction. And you sit there going like, why did it do that to me? Why did that,
Well, that's the whole purpose of talking about this.
Exactly, because now you've got a formula to put it in and how to trail it. When it comes to as far as profit targets are concerned, you're not suggesting that you just basically run the trade until the trade doubles back on your stops. You have
no.
Yeah.
Well, there's two ways to look at that. What we usually do in taking a trade is we usually do a risk to reward. So we don't take a trade unless the risk to reward's 2 to 1 in our favor.
Okay.
So that's step one, whether we're day trading or position trading. And then, we have a whole set of software tools that, give us entries, timing, and then we use multiple time frame analysis. We're looking, for example, when we day trade, we use the 1 minute, the 10-second, believe it or not, and the 5 minute. And on Tuesday, when we were trading, we had to wait an hour and a half. You think that's a really short time frame and you're going to be trading a lot? We're so structured and there's so many things that have to be met in our trading rules before we can enter the trade that sometimes we have to wait quite a while before everything lines up. Now, with that said, once we get a trade entry, all right, getting back to your question of target zones, we usually use fib extensions and retracements, Elliott wave and things like that when we analyze the markets. But you can be right on your analysis of the target zone, But the biggest problem people have during elections, which is why I created this PowerPoint presentation, was your stops.
Yeah.
And I think that's kind of, Raleigh, what you were alluding to.
You're right. How do you create a stock that gives you enough room to breathe, if you will, in a volatile
Exactly.
situation, and at least have the peace of mind if everything craters, you're taken out?
That's right. And the other thing too is that, especially when you're day trading, you have to have a lot of structure because your emotions
Yeah,
will be your worst enemy.
absolutely.
And I'll tell you, there's another thing. If you trade one market and one market only, it's going to be much harder. Better to trade multiple markets where you can take your mind off each and every price bar, because from an emotional standpoint, if you watch every price bar, and I guarantee you, if anybody else does this out there, if you're day trading and you watch one market and one price bar, you're going to trade that market differently than if you're focused on another market and just let that market unwind.
Mm-hmm. Mm-hmm. That's a good point. And so from that perspective, do you have, what are the markets that you like to trade, Bennett?
Well, we trade, it depends. For day trading, I do not day trade stocks. I only day trade futures.
Okay.
Position trades, we do futures, we do stocks. I do not do Forex. I have a lot of clients that do, but I don't. I don't trade really bonds much at all, anything like that. So pretty much position trades are done on futures and stocks, and day trading purely on futures market. And my four favorite for the futures markets is the S&P,
Okay.
NASDAQ, gold, and also oil. Good liquidity, and they all have micros. So for those starting out new, the micro market, Raleigh, is fantastic because you can get your feet wet, get used to the emotions in the market, and, it's not a lot of money.
Yeah, no, that's great. I was going to ask you that. So you have seen I haven't traded the micros yet. I know when I was just starting to trade futures, I would trade the E-mini Dow is how I would wade in the pool, and
Well, that's a good one too.
but the micros, so they're taking off. Good volume, good liquidity there.
Yeah, the volume, you got to be a little bit careful on picking the right expiration date because the volume will vary quite a bit, and on the micros especially.
Right.
For example, on crude oil, the regular CL contract, the month that we choose for that is different than the micro month.
Okay.
Okay, so liquidity goes down quite a bit on
Ah,
certain
okay.
markets.
Interesting. Well, I like that. I mean, I'm just comparing notes here because I look at those four markets plus the E-mini Dow, and I look at the 6E, the
Well,
euro.
it's funny. We started a trading room, Raleigh, and the trading room, it's about 2 hours long, right? So we do it a couple of days a week, and the time frame you choose based on a 2-hour time frame, it can be a lot different than if you're going to trade all day.
Yeah.
Okay. So we shortened it. I mean, it was getting to a point where we had the 5-minute as our primary time frame, but the rules are so specific that you can literally wait quite a while before taking a trade.
Right.
And so we lowered it to a 1-minute time frame, and it works just as good on a 1-minute time frame, and you trade more often in a shorter period of time. So it's kind of interesting because people think, well, my God, you're trading a 1-minute time frame, and that's kind of ridiculously low. Well, it is low, but it's not as bad as you think.
So when it comes to trading, do you have a preferred time of the day that you like to trade, like the first 2 hours from the open, or?
Well, that's a really good question. I mean, if you can do it, if you have the time, you should, start right at the beginning and take it all the way through the day, But usually it depends. Every day is different. Okay. For example, on the oil and gold markets, we do look at overnight data. So that kind of gives us an idea of the Elliott wave. We get our target zones and so forth from that type of history. However, in the S&P and NASDAQ, we really don't look at the overnight data because liquidity goes down. So we're focusing more on what's happening for the first half an hour in terms of ranges and so forth.
Okay.
So every market's a little different in how we approach it. So in
Sure.
other words, we may trade right, out of the gun, so to speak, right away on oil and certainly on gold, but the NASDAQ and the S&P, we may hold back a little bit unless something's really obvious.
Okay. It makes all kinds of sense in the world. Just also interested in this, philosophically speaking, how do you deal with news events, especially news
No,
events that you know that are coming up?
I don't.
Okay.
I'm a purely technical trader. I'm so structured in my approach that news is not factored in one bit.
Oh, okay. So, for example, crude oil inventory report. You'll be
No,
in
don't even
crude.
look at it.
Okay.
On a 1 minute time frame, don't even look at it.
Don't even look at it. Okay.
Okay. Now, if you're talking position trading or something, maybe, but even then, I'm so structured. It's, I'm a old fashioned technical guy in that I believe that everything you need to know about a market is built in the price and the history
Sure.
of that price is the reality of the market. So I use that information to basically formulate my trading plan.
Sure. Question from one of the folks that was listening, earlier on, just wanted to clarify. So you do trail your stops?
Yes. Oh, yeah. Absolutely. And in other words, again, here's where structure, and I don't know your trading approach, but with our trading approach, if our indicators are showing an extremely bearish market underway, then we'll be much less quick about moving our stops than a market that may be close to a change.
Yes. And it's interesting just thinking about this now when you were going through your example of how you calculate where to place your stops. I'm sitting there going like, man, this is changing every 10 bars. That's a lot of math. So you've got some cool button that you hit? You've got it automated on your chart?
This approach is not a lot of math. I mean, you just take the high and low, all right, subtract it, divide it by 10, and then add the result of that to the high or the low of the price bar that represents the high and the low of the last 10 price bars.
Right.
It's
Well, I'm just thinking if I'm working on minute bars, I'm going like, damn, this
all right.
changing
I'll
the
tell you what,
time.
Riley, I'll create a new piece of software that'll do this. It'll be good. Next time I come on, I'll sell that.
Maybe I've just been, I've been in the webinar all day long. I'm just trying to think about it. I'm going like, oh my God, this thing is changing dynamically so fast.
Right. I'll have that ready for you tomorrow.
Oh, thank you. Thank you, sir. Appreciate that.
But this is just one way of doing it. Now, the other thing too is that I may not use this approach if it's an orderly market.
Yeah, that's
okay. But if I see it getting out of hand a little bit, and I see this type of situation, and elongated price bars are usually a good visual that you're having something going on in that particular period.
sure. That makes that was the other question that I had was that, once again, the emphasis here would be, guys, we're talking about a cool trick for trading volatile markets with some confidence, knowing
Right.
that you're protected on the back end. But in what we would call like more normal markets, you may have a different approach to how you establish your exits and trail your exits.
Yeah, for example, Raleigh, on this, if maybe some people would just put their stop one tick below this price bar. Okay.
Mm-hmm.
So we're saying give it a little bit more room based on the current volatility.
Sure. Question just came in here. Is there a way to apply this to credit spreads?
I would say no, you really wouldn't want to do that, except if you were using the underlying assets price movement to dictate a level that you'd want to unwind that particular spread.
Okay.
Probably not. Usually when you use options, you kind of should be in a situation, depending on the option, but you kind of should be in a situation where the risk is built into the option play.
Okay.
Not always, but most of the time.
So it was noted by several folks here in the room that you've made reference a couple of times to Elliott wave.
Yes.
And how important is that into your trading decisions that you make?
Well,
as you look at the
it's
market?
actually pretty important. All right. If a market is not to me clear on an Elliott wave on one of the 3 time frames I'm looking at when I analyze a market, for example, if I'm looking at the S&P and it's a real short time frame, I'll have the 10-second, the 1 minute, and the 5 minute. So I'm looking for Elliott waves on those time frames. The 10-second to me is more used just to make sure that the momentum is in the same direction that I want to go in on my primary time frame, which would be the 1 minute. Probably the Elliott wave on the 5 minute can be used for target zones, but a lot of times you got to be careful with that because on a 1 minute time frame, you could have a pullback that could take you out of a trade, even though the target zone is based on the 5 minute time frame. So the primary time frame has got to rule what you're doing. So I usually look for an Elliott wave on that. If I don't see an Elliott wave, then I consider the trade a scalp trade, and I have an indicator for that called the PTF that I use for that. But again, the risk to reward's got to be 2 to 1 or better before I take a trade.
Before you're going to take a trade. So that's a hard and fast rule for you.
Yeah. And then I have to have momentum go in my direction, and then a couple other things in terms of price pattern that the software that I use called the ART software tells me.
You had something to do with that, didn't you?
What's that?
The ART software?
Yeah, a little bit.
Just a little bit. Well, I tell you what, with a 2 to 1 reward to risk ratio there, then holy smoke, you're talking about if you're right 50% of the time, you're in good shape.
That's the whole point. The other thing too that we do is we calculate trade size. We take basically trade size. The way we do it, we have something called the risk to reward calculator that I have. That basically what we do is we put in the account size, we put in the possible entry price, and then the exit price, and you put in, if it's a futures trade, you put in the margin. You put in the amount the trade's going to cost you, so you get the right calculation, and you got to put in the point size. For example, if you're trading the E-mini S&P, then the point size is 50, right?
Yeah.
If you're trading the micro, it's 5. So you need to calibrate the calculator correctly. You hit, and then you put in your target price, and you press the button. There's your button, okay? That will give you the number of contracts you should trade with on that trade, either long or short, depending on the direction. And it will also give you your exact risk to reward number.
Man, I tell you what, folks, I don't know about you, but at least for me, what I'm really appreciating what Bennett is talking about here is, number one, is a very, very structured business-like approach to trading. And when it comes to futures trading, I will be another testament to this, is that if you think you can go into this market and wing it, you're going to get killed. And so having a trading plan, having a strategy, having disciplines, having hard rules, things like looking for setups where your probability of a 2 to 1, risk to reward ratio as being a driving factor as to when you go into the market, and having discipline around that, that's the best way to achieve consistency in the market. And I know sounds like I'm drinking from the Kool-Aid, Bennett, but I've learned a long time ago that if you don't approach the market this way.
I think we learn through our mistakes, right?
Yeah. I'm speaking.
No, you're absolutely right. I mean, I can't tell you, there's some trades I get really excited about, even when I'm day trading, but then I do the risk numbers and they don't come out. And it's a bummer, because you have to pass on the trade, even though it's probably going to go up there. The risk reward's not there. So you got to be disciplined. It's very hard to do that, and you're going to make mistakes along the road. We're all human. We all make mistakes, but it really need to be really structured about it.
Absolutely. And just as we're winding down here a little bit, coming back to the primary theme of the webinar, presidential profits, leveraging the election cycle. I mean, one of the takeaways that I've got from your presentation is that, as far as you're concerned, let's say day trading the futures markets, everything that you need to do is already priced into the market. So you're not
Yes.
really, if I understand you correctly, you're not sitting there thinking about, well, the election's not decided yet, or if, Biden's the guy, this could happen, or if Trump comes back in. As far as you're concerned, for your positions as far as day trading is concerned, it's all there in front of you.
That's right.
I tell you what, guys, that's the long and the short of it right there. When you think about your trading, Bennett, just sharing with us,
Yeah.
are you, what's your mix on your trades? Does it depend on what's going on in the market, or do you tend to favor futures day trading, or are you looking at some swing trading, some position trading?
Well, that's a good question. Here's a couple things that might be helpful to some people out there. Um, it depends on your finances and whatnot. But what I like to do is I like to have three different types of accounts. I like to have a day trading account with a broker, a position trading account, and then you can have some long-term stuff. But they're all technically opened up in separate accounts. And by doing that, you don't commingle the trades. Okay, so you know what account is day trading, what account is position trading, what account is other stuff. Even if you want to have a retirement or something like that. But the idea is when you go to analyze, and you should analyze your trade. We have something called the Trader's Assistant, which you put all your closed trades in, and it gives you all the numbers you need to analyze your trades. But the idea behind this is there's going to be periods when it's better to position trade than day trade in terms of dollars. Okay, it doesn't mean you have to stop day trading, because there's always going to be intraday trends. But when you segregate the accounts, it's always interesting to see when you go back after a quarter, 3 months or so, analyze your trading and see which style is doing better. Now, with that said, what people have to realize is that, do you realize if you're right just 60% of the time in the market, or anything over 50, but you have a 2-to-1 payoff ratio, meaning that for every dollar you lose, you're winning 2. Okay, you're going to be successful.
Absolutely. And, the point that one of the reasons why I would have mentioned that there's a lot of folks that are fixated on winning percentage.
Right.
And, the things that people need to understand is that if you want a 90% winning percentage, well, you're going to be scalping the markets. That's all there is to it. You're going to
be you're going to be one of those guys, Raleigh, that waits for 10 years for the right catastrophe.
Right. Because, and it's just natural, especially people new to trading going like, wow, a 40% winning, that doesn't sound like it's really good. But if you're making 2-to-1 or 3-to-1 on that, guys, and you do enough trade, you'll prove it to yourself. You're going to make money over the long haul. There's no doubt. So that's that's the balancing act that you have. But that's something we can, I think from our experience, we can share with most people. Don't get so darn fixated on winning percentage. You're not going to find a 90% winners percentage that's going to give you a 3-to-1 risk to reward. It's not
Amen.
possible.
That's right. The other thing that's interesting too, Raleigh, just to piggyback one last thing, is that, when you talk about winning 60% of the time, if you go into each trade with a mindset that you're only going to take the trade if it's a 2-to-1 risk to reward, one of those 6 trades, could win a lot more. So if you're doing your trade size on each and every trade, and you're risking 2% of your account, out of every 10 trades, roughly, okay, you're going to be losing 4 trades at a 60% win ratio. That's 8%. 2% loss on 4 trades, 8%. So that means that on the other trades, all you have to win is a little bit, but what happens is you'll win a lot on one of those 6 trades if you follow the rules and don't get out of trades too soon.
Exactly.
So let your winners run.
Exactly. Well, Bennett, I want to thank you so much for your time today. Once again, like so many of the speakers, that we've had on board, we know that you all are busy. And to try to grab you during the middle of the day when the markets are still going, et cetera, it's just a privilege to be able to spend some time with you. And I really do appreciate the time that you spent with us and sharing one of the keys to your success, which is trading volatility with a very, very specific, exit plan and approach in mind. And once again, I want to thank you very, very much for being with us here today.
Well, Raleigh, the privilege is mine, and it's great to always do things with you, Pat and Nikki. I really appreciate you inviting me. It's fun.
Outstanding, my friend. Take care. Have a good rest of the day. I'm going to grab the screen here for a minute.
Great. All right.
And
Thank you. Bye-bye.
take care.
Thank you.
Bye, Pat. Bye, Nikki.
Bye.
Bye.
Share. There you go. So once again, folks, that was Bennett McDowell. His high volatility exit plan course is available for $99. The focus is on a step-by-step trading exit plan approach with very, very simple rules. It works in all markets, time frames, and market conditions. Ongoing live training, email support, everything. It's just a really nice package. And if you go to westmarktrading.com/M11-elevate, you'll learn a lot more there. But I encourage you to also just visit his site, because I hope you can appreciate through our discussion, there's an awful lot that Bennett and his company makes available to traders across the board. This is just one little nugget of what they do. So, ladies, how are you doing? We're near the top of the hour. Should we venture forth a quiz?
I think we
so.
will, and I will visit with my man Bigelow afterwards. Hang tough there, Steve. Be just a minute.
All right. So it is quiz time. We're just a little bit ahead of time, which is always good when we're running a multi-speaker event. So it's one of the things that we pride ourselves in. And so it is quiz time. So how does this work again?
Oh, let me see.
Well, there's a $100 Amazon gift card that you can win if you guess the answer first to the question coming up.
All right. And the question is,
Who is the only president to serve as Chief Justice of the Supreme Court? Ooh, that's a good one. Do we not have a winner?
Oh,
No one
this
has
may
guessed
be a
it.
tough one. Time to Google.
This
Come
hasn't
on.
happened yet. All right,
no.
we're Googling, people.
Hey, our friend TS out there, he always gets them right. If you beat everybody, I'll give you another gift card. he's so,
Do I have to rerun the music here?
I don't know.
Anna, you got another song?
Good heavens.
My gosh, let me see.
Stuck in my head. Yeah. All right, let's see. Moderate.
Form the banana, form the banana, form the banana, form the banana.
This is called the banana
Peel
dance.
the banana, peel the banana, peel the banana.
Do we have a winner?
We do, thank God.
Goodness.
Okay, the first person, okay, it's BRZ 549. I guess this is his handle or her handle. BRZ 549. You are the winner and congratulations. Let's see what the answer is.
Okay.
William Howard Taft, 1920 to 1930. He often remarked that he preferred the law over being a politician.
Yeah, it was amazing just reading a little bit about this. As he was president of the United States, he was constantly bemoaning the fact that he was president and just wished he could go back to being a judge. So after his term was over, his wish was rewarded and he was appointed to the Supreme Court.